Thank you all for tuning in. Now, I can't promise you the outcome that you're gonna get from watching this, but what I can tell you, if you apply what you're about to learn, this will change your financial future. If you're here, it's probably because you're ready for change. And what you're gonna learn in tonight's training will do just that. So if taking back control of your money isn't enough to keep you glued to this screen for the next 90 minutes, I think it's time to reassess your priorities. And tonight, we've got a special guest. My good friend Brian is gonna be doing the training, and here's what you can expect to learn. Number one, you're gonna learn how to take back control of your money. And you're gonna do that by learning how to be the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses. And you can do that without working harder, without working longer, and without taking on any additional risk. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. That's exactly what you're gonna learn in tonight's training, so get ready, get set, let's go.
Take back control.
Tuesday night.
Tuesday?
Welcome to the presentation of the Money Multiplier, Mapping Out the Millionaire Mystery and Infinite Banking. To get started, I want to ask everybody here a question. Now, those of you that have heard this question before, don't answer it. But the question is this, is what in life should you control or want to control? For those people who are new, so there's three things, by the way, there's three things that I believe that we should all want to control. And these are the things that when you don't control them, somebody else does. So anybody want to take a guess as to what one of those things might be that you might want to control? Yes, money. So Magnus, awesome. That is the first one I always say. Money is something that we should want to control, because here's the thing. If you're not controlling your money, most likely somebody else is controlling it. Think of like banks, corporate America, etc., like government, all that. But there's something else that we definitely do want to control, and that is time. Time for me, by the way, is my main thing. But if you want to control time, you need to control money. And so most people get this thing backwards, because time is that one thing that once it goes, it never comes back. So for me, above all else, I want to control my time, and I have to control my money in order for me to do that. I work from home. I've created this lifestyle because I want to control my time. But there's one thing above all else that you have to control first before time and money, and that is your mindset. That is knowledge. Because if you're not controlling your mind, your subconscious programming, we call that, then you're being programmed by somebody else, or you're being controlled. And so we definitely want to control what's going on up here and what is going into our mind and influencing us. So as we go through this presentation, just keep these things in mind. Now, there's a quote that we here at the Money School like to share, and it's by Will Rogers. And this quote is this: "The problem in America isn't so much what people don't know, it's what people think they know that just isn't so." So we're definitely going to be challenging some mindset as we go through this presentation. Now, I want you to think about this for a second. Let's just say that you take 100 18-year-old kids, okay, you call them kids, right? And you put them into a room and you ask every single one of these 100 kids, where will they be, or where will you be at the age of retirement? Okay, 65 years old, let's just say it. Now, are they going to say I'm going to be broke and poor? No, of course not. They're going to say I'm going to be successful, I'm going to be a multimillionaire, whatever, right? They're going to be very successful. But here's the challenge. According to the Social Security Administration, only 5 out of those 100 kids, so 5%, will be financially secure at the age of retirement. And to me, that is crazy. Here in the United States, or Canada, you can include Canada as well, one of the most wealthy countries in the world, yet only 5 out of 100 people are even financially secure at the age of retirement. That's crazy. So this concept, infinite banking, that we're going to be talking about here today, so that we want to be one of those 5. And so in order to typically become one of those 5, sometimes we got to do things a bit differently than what we're doing today. And what we're going to be talking about through this presentation, and even on a call one-on-one, is how to do that, how to do something a bit different. All right, so real quick, a little bit about me, just so you guys know who I am. So my name is Brian. I went to Washington State University and I got a degree in construction management and business. That's what I thought I was supposed to do. And I call that the hard way, the hard journey. But I was raised, lower income. We never talked about money in my family. My parents were still together. They're a great family and all that kind of stuff. But yeah, just never talked about money. And I was told to follow that traditional path through life, right? Go to school, get good grades, get a job in corporate America, which is exactly what I did. Had that 401k, house, growing family, all the debt associated with it. And I was told that I had the American dream. Probably heard that before. I felt like the American nightmare to me because I was drowning in debt. I didn't enjoy my career, my job, all that kind of stuff. And I was at a doctor's office. This is a kind of a quick story that I share. I was at a doctor's office. Remember how I used to have those magazines on the coffee table? Now we just all have our cell phones. But I picked up this financial magazine and I was reading this article about millionaires, and it said that millionaires know their net worth. The average person doesn't. And I'm like, oh, I don't know my net worth. So I went home and did the math, and I was worth a negative amount of money. And that made me realize that I had to change something in my life, right? Because it's not working right now. But we all kind of have those epiphany moments sometimes. And mine was my grandfather. He was my idol. He was a renowned person in our community. And he was working all the way up until like 60 something, 67 to retire. And he was excited about retiring because he was going to go buy this motorhome and travel around the country with my grandmother, his wife, and go to sporting events. And he actually did buy the motorhome, but not even 2 years later, he got really sick. He got Parkinson's, leukemia, kidney failure, and he ended up passing away without really living in retirement. And the last thing he said to me that it really stuck with me is, live your life today, Brian, don't wait. And so I decided to make a change. And I left my career eventually and got into entrepreneurship and bought a business, created some businesses. This is one of my businesses. I share this just to kind of make you understand that anybody can say anything on the internet, but this is one of my businesses that did over 7 figures in 2021 during COVID. But the core concept that allowed me to do this business was what we're going to be talking about here today, the infinite banking concept. So I've been teaching and doing presentations on this concept for about 10 years now. And this is one of the businesses that I used to run. I don't run it anymore, but the core of it was this business. But it allowed me to do one thing above all else: control my time. And I love that. My life kind of changed. My family and I, we love to travel. We don't do as much traveling now because my kids are a bit older, but when they're younger, it was easier. But I love to travel and have experiences. I love just having experiences, but I love sharing this concept. And so this is actually me at an event sharing this concept with a high-level mastermind group. And I love doing it today, sharing it with you. In April, I'm going to go on a cruise and I'm going to go share this with some other people. And I just love doing it and sharing this because it has changed my life, and I've helped thousands of people do this. So it's a lot of fun. Now, but I want you to understand one thing, though, that this concept that we're going to be talking about here today is not new. It's been around for over 150 years. And actually, Robert Kiyosaki, so in his book, Second Chance, which I recommend that book, it's a great one, he talks about this concept. And I know about 3 or 4 of his personal advisors, and one of them was my mentor for infinite banking. So once I got into that circle of influence, I realized that they're almost all doing infinite banking. And so one of his guys was one of my mentors for this concept. Tony Robbins, I've been to a couple of his events. They're a lot of fun, but he talks about it in his book, Money Master the Game. And then, of course, the kind of the foundational book for this concept is by Nelson Nash, Becoming Your Own Banker. Great book. I recommend that one. Or you can go check out the Nelson Nash Institute as well. And then there's my friends and mentors, so Brent Kessler and Chris Naugle. They have a book called Mapping Out the Millionaire Mystery. And then Chris also has one called The Private Money Guide. And I said this concept is not new. So who has been using this concept throughout history? Well, Jim Harbaugh, actually, he was at one point one of college's top paid coaches, University of Michigan. They actually compensated him through this concept. So he was paid through cash value life insurance, which we're going to be talking about. So it's pretty cool how they did that. And if you ever want to know why they did it, I'll explain that on a call, because it's pretty cool why they did this. This gentleman, you may remember him, maybe not. Hopefully he remembers himself. Mr. President Biden, he has 6 of these policies, we found out. So it's kind of cool. Walt Disney. So Walt Disney, when he was trying to start Disneyland, he couldn't get a loan from a bank because they weren't lending. This is back in I think the teens or the 30s. Can't remember. But he couldn't get a loan. So he actually had infinite banking in place, and he went and used that to start Disneyland. So it's kind of cool. We wouldn't have Disneyland as we know it today, possibly, without this concept. Ray Kroc. So good. I like the movie that they did on him, but Ray Kroc, when he partnered and they took over McDonald's, he grew the business. And so he used the cash value policy that we're going to be talking about to actually grow McDonald's because he didn't have the cash available. Pampered Chef, so she used some funds from this policy, from this concept to create that business, the Pampered Chef. I think Warren Buffett now owns it. It's worth, probably $1 billion or something like that. It's pretty crazy. And then lots of wealthy families have been doing this for generations. So Morgans, Chases, Vanderbilts, Rockefellers, Harris's, they've all been doing this. And I've been fortunate to sit down with some very wealthy individuals, and they have shared that they do infinite banking. So it's kind of cool to see what they're doing behind the scenes. But question is, what will infinite banking do for you? So here are some things that as we go through this presentation, keep these things in mind, because this is what this can do for you. So 1, it creates guaranteed tax-free, by the way, generational wealth day 1. It allows your money to grow uninterrupted, compounded, which I'm not sure there's anywhere else that really does uninterrupted compound interest that you can earn. This is one of the few places that I've ever seen that does this, but it does that for the rest of your life, and it has guarantees on the growth as well. So I like guarantees. It takes the control of your money. So remember, the very beginning, control of money. It takes it away from the big banks, away from Wall Street, away from corporate America, and puts that control into your hands. If you want to build wealth or have more money, more wealth, you got to control what you have. So there's a big part of what this does. It protects your money. If you're going to make money, you also want to protect it. So it protects it from lawsuits, from bankruptcy, from divorce, and court orders in most states. Not all states, by the way, but in most states, it's a protected asset. And then, of course, it allows you to be the bank for things you may normally use a bank for. So think about like investing, retirement, college, buying cars, real estate of all different types, homes, all that kind of stuff. But the cool thing about what infinite banking does for you is it does all of these things at the exact same time, not one or two of these things, but all of them. So it's pretty cool when you see this thing in motion or in your life. It's pretty cool to see all these things going on at the same time. It's pretty amazing because when you first are doing this, like, okay, that sounds cool, and then you see it and you're like, oh my gosh, this is awesome, because it is pretty cool how it works. Now, some things I want to make sure that we do get clear on first. I want to clear up some things real quick though. So one, what is the definition of money? So it's just a means of exchange, as it is defined in this presentation, just a means of exchange. Are your dollars worth more today or in the future? So we all know that $1 today would have bought us a lot more candy in a candy store 20 years ago than it would today, right? So we know that our money is worth more today than it is down the road. So we want to make sure that we are using our money as efficiently as possible, not parking it somewhere and waiting 20, 30, 40 years before we can touch it. Will taxes go up or down? Okay. I would love to say they go down, but historically they've always gone up. So would you rather pay taxes today or pay taxes down the road on your money after it's worth less? So in most cases, it's called the seed and the harvest. Would you rather pay taxes on the seed, or would you rather plant the seed and then harvest the crop and then pay taxes on the crop? If you do the math, you want to pay taxes on the seed, not the crop. But that's the exact opposite of traditional retirement accounts like an IRA, 401k, things like that. You pay taxes actually down the road when taxes are higher and your money is worth less. Kind of weird that we do that, but once again, that's how traditional retirement accounts work. Now, why do you think the IRS does the tax deferred strategy in a 401k? Because they know they're going to get more money down the road and they're actually going to increase taxes down the road. Kind of a strange thing that we do that. But with infinite banking, it's the exact opposite of that. So you pay taxes today and not down the road. Now we're going to be talking about the bank, becoming your own bank. So in order to understand like why you want to become the bank, let's look at a traditional banking function, which is buying a car. So most of us have bought a car, whether it's cash or whatever, we've bought a car. So let's just say that we're going to go buy a car, and let's say it's going to be a $25,000 car. Doesn't really matter the amount, $25,000. And let's just say that in the bank, you happen to have $25,000 of cash sitting there. So what are you going to do? Well, traditionally, I'm going to go take the cash out of the bank and go buy the car with cash. But let's change that around. Let's say that you go to the bank and the banker says, hey, Brian, before you take this cash out of the bank, what if I do this? What if instead of you taking the money out, what if I give you 4% on the money? You leave it in the bank and I'll give you a loan of $25,000, 6%, let's just say, at 60 months. And I'll use your cash as the collateral. Does this make sense? So let's do the math on this. The monthly payments on the car loan are $483 per month, or if you look at the future value of all the payments added together, it's going to be $28,999. So $29,000. But what's the future value of the money that's in the bank? It's $30,525. So what does that mean? It means that by leaving your money in the bank at 4% while paying back the loan at 6%, you actually made $1,526. So you made money while earning 4% and paying 6%. It's just math, by the way. What this means, here's what people always say to this one. They'll say, well, wait a second, Brian, if I paid cash, I would have no monthly payment. Yes, that's true, but let me ask another question of them. How'd you save up the $25,000 in the first place? In most cases, we saved it up by saving up monthly amounts and got that cash in the bank. So if you spend $25,000 of cash for the car, would you save up the money in the bank account again? Yeah, of course, because I don't have any savings anymore. I want to build it back up again. So in reality, the cash flow in this example is no different than if you paid cash for the car and saved up your money again to replenish your savings account. In this example, though, you made money. So there you go. So that's just how this can work. That's a quick example of how banks function. Let's kind of get into it. So here's the three things we're going to be talking about here today. So the first thing is going to be the machine. Okay, what is the machine that allows infinite banking to function and exist? The second part is the marathon, because building wealth is not a sprint, it's a marathon. And then, of course, the legacy and the wealth building. How do we build that millionaire, legacy in our lives? So let's go into the machine. So I want you to think about this. This is my analogy. So think about infinite banking like a car. Okay, it's a car. And a car has wheels, it has a steering wheel, hopefully, it has seats, all that kind of stuff. But if that car, which is infinite banking concept, doesn't have an engine, can that car function and go down the road? No, it cannot. So it has to have an engine that would go down the road. The most efficient engine that is available for infinite banking, that car, is going to be a specially designed, dividend-paying, permanent whole life insurance policy with a mutual insurance company. So why do we say that? Well, a mutual insurance company is owned by you, the policy holders. They're a private company. They're very profitable. They've never lost money in history. These companies have never lost money, and they paid dividends to you, the policyholders, every single year they've ever existed. So very, very stable financial institutions that have been around for anywhere from 120 to 185 years, or some are actually over a couple hundred years old. So they're very stable. They've never gone bankrupt, all that kind of stuff. Now, the last thing I'll mention is why a whole life policy. Why not like an IUL? Why not a VUL? Why not like a 401k loan? Well, guess who the biggest buyer of infinite banking policies is in the US? It's banks. Traditional banks own more whole life insurance than they do their real estate and buildings combined. So if these banks are the biggest buyers of infinite banking and they're buying whole life insurance policies, not these other types of products, but whole life, why wouldn't you want to do the same thing? Do they know something that maybe you don't? Possibly. But yeah, so banks own a lot of life insurance, a ton of it. It's called BOLI, by the way. You can go look it up. But yeah, they earn or buy quite a bit of it. So once again, want to make sure you understand this. You can earn 4% and pay 6% and actually make money, make profits. So keep that in mind as we go through this, because that is really how banks function. So what do banks do with your money? So this is pretty crazy because banks don't just sit on your money. So let's just say that you give a bank $100,000, and let's say they're going to be a very nice bank. They're going to give you 4%. Do they just sit on that money? Well, no, they can't, because they owe you that money back. They control that money now, though. By the way, I don't know if you knew this, but when you give bank your money, they contractually own your money now. They can use it contractually. It's kind of crazy. But they don't sit on that money. They put it into motion, because money in motion makes money. Well, they're going to lend it right back out again, maybe on a home loan at 7%. What's the seller do when they receive the proceeds? Put it right back into the bank again. But the bank does not sit on that money, right? They loan it right back out, maybe a car loan. That money goes right back into the bank again. They loan it right back out, maybe on a home remodel or something like that. But the contractor puts it right back into the bank again. So you can see the cycle here. Maybe they do debt consolidation, but the credit card companies, eventually the money all gets put back into the bank. So the bank is just cycling your money over and over and over again, to the point where they're going to make 500% more on your money than they're actually paying you on that same amount of money. And if you don't believe me, by the way, it's just math, but Bauer Financial, they used to report, I think they still report this. You can go look up and see how much banks are making, right? 400 to 1,300% on your money. Yeah, boomerang, right, Dex? Yeah, it goes back and forth, back and forth, back and forth. And that's not even accounting for fractional reserve banking, which means banks can lend out 9 times what they have on deposit, which it should be illegal, by the way, but it's not for whatever reason. So that's what banks are doing with your money. Now, what I want to show you now is how to get all the money back for every car that you ever buy, drive, and own by being the bank. So before we get into that, I want to look under the hood. Let's look at the engine, which is obviously a dividend-paying whole life insurance policy specially designed. Now, you're going to see on the screen here, you might not be able to see this, but this is what's called a tabular detail of a policy. Now, there's a few things going on here that I want to point out real quick. So one, with infinite banking, you're going to have what's called a premium, right? Just like car insurance or home insurance, except with these ones, we call that a deposit, because you get value out of it. You deposit some money into your banking system, your policy, you can borrow it right back out again. So you can see right here in this example, we're putting in $10,000 right there. You can see that there. But here's what's happening with infinite banking is because it's designed to have what's called cash value, you can borrow back out of it. And you'll see that right over here, cash value. And these are very, very ultra conservative numbers. The policies that we build have a lot more cash value, but once again, I want to be very conservative. But as you fund the policy, the cash value grows. As the policy ages, you earn dividends. So dividends come in every 12 months and they add to the cash value. So those compound for the rest of your life. So that cash value is going to grow faster and faster and faster. No matter what, if you borrow from the policy or not, doesn't matter, you still earn the same dividends with the way that we build these. So that's what's going on right there. The next thing is age. So a lot of people say, well, okay, do I need life insurance? Can I get life insurance? Am I too old? Am I too young? All that kind of stuff. Age really does not matter, but I will be very clear and very honest here. There is an age at which you cannot do infinite banking anymore. And that age is, by the way, 74, 75. I think it's for males, it's 73. For females, I think it's 74. And then the last thing I'll mention here is death benefit. You'll see that over here. Now, when people think of life insurance, death benefit is exactly what comes into mind. But we're not going to focus on the death benefit with infinite banking. I mean, it's there and we'll talk about it, but we're going to focus on the living benefits, right? Because we want to use this. We want to use our money today, tomorrow, next year, and down the road. We want to be using our money at the exact same time it's growing inside this policy and it's protected and all those other benefits. So let's get into this example of how you can fund your cars. This is a simple example here. All right, so let's go ahead and set this up. Now, in this example, we're going to deposit $10,000 a year. That's a premium deposit. Now, you might be saying, well, $10,000 is not very much, or it sounds like a lot. This is just an example. Your numbers are your numbers. I'll get into that in a little bit in the presentation as to what your numbers can be. But for this example, $10,000 per year, that can be monthly, can be annually, however this person wants to do it. Now, as this policy grows, cash value is going to grow as well. Let's just say at the end of year 3, we have around bit more of $25,000 in this policy. We have that as cash value. We're going to go and we're going to take a loan. Now, this is a loan from our policy. It's a guaranteed loan, by the way, and it's a private loan, meaning it does not show up on your credit report. Okay, so we borrowed $25,000 to go buy a car. Now, one thing I want you to understand is we're buying the car with cash. So it's kind of funny. I bought a car with a loan and I bought it with cash. When I had cash, I actually got like a $2,000 discount on the car. With a loan, they don't do any discount. So I actually paid less by paying cash. So we borrowed $25,000. That's a policy loan, but we're going to pay ourselves back. We're going to pay back the policy loan just like we would any traditional bank. And let's say we do it at $500 per month or $6,000 per year. So there you go. All right. Now, what do the numbers look like so far in this example? So we put in $70,000 over 7 years. That's the premium deposit. We also paid back a policy loan. We paid back $30,000 with interest, right? So we put $100,000 into the policy, so to speak. But guess what? We also took $25,000 out as cash. So let's make sure that we account for that cash that we had. And by the way, I'm using a car example. You could go buy real estate. You could go do something else, pay off debt, which we'll get into here in a moment as well. That means that you've put in $75,000 into this policy. But as far as the cash value goes, you've recaptured 91 cents of every dollar that you put in the policy. It's right there as cash value. But now this is where, and by the way, this is once again is a very conservative one, but the next set of years is where it gets really powerful. So I'm going to go look at years 8 through 12, the next 5 years. Now, let's just happen to say that, hey, guess what? What if I don't want to fund my policy, my infinite banking policy after year 7? Well, you can drop it down to 0 if you want. We don't recommend that, by the way, but you can. So nothing else goes into the policy in years 8 through 12. But guess what? The cash value still continues to grow for the rest of your life. So at year 8, let's just say, you want to go buy another car. Maybe your daughter turns 16. Mine turns 16 in September of this year. Lord help me. She's going to want a car. But let's just say we go and buy a car, another one at year 8, same thing. We structure that loan back just like we would any other bank, pay it back at $30,000 over 5 years. But remember, we had cash we took out. So in reality, we only put in $5,000 in years 8 through 12. But if you look, this is kind of cool. Between years 7 and years 12, the cash value grew by $23,592, yet you only put in $5,000. That's the power of dividends that compound right there. Now, one last thing I'll mention on this very simple example is over these 12 years, how much have you put into this policy? Well, $75,000 here and $5,000 here. That's $80,000. But how much do you have access to? $91,000 and change. And also, you own 2 cars outright. So you own the 2 cars and you've actually built wealth at the exact same time. Once again, conservative estimate, but this is a very simple example of infinite banking right there. And by the way, when you buy the car with cash, who has the title? You do, right? Who controls the loan? You do. Not a bank, not a credit card, credit company, nothing like that. You control it. Now, there's three rules that we want to make sure that we are thinking about when it comes to infinite banking. Now, the first rule with infinite banking is pay yourself first. We are programmed, remember mindset, right? We are programmed to pay everybody else first. Banks, mortgages, credit card companies, all those other things we pay money to. We're programmed to pay everybody else first. With this one, you want to pay yourself first. Pay yourself with interest. So if you're going to borrow from your policy and pay it back with interest. Be a responsible banker is what we call it, right? Because if you're the bank, treat yourself just like you would a traditional bank. Pay yourself back. And the last thing is recycle and recapture your money. What that means is if you're going to have a banking system, use the banking system, right? Just recycle and recapture money through it as much as possible. You're going to benefit. This works for a car, works for real estate investing, all that kind of stuff. But what else can this work for? So let's give an example of debts. So debts are one of the biggest things that steal wealth, by the way. Most households are paying over $20,000 a year in interest, which is just money that you can no longer use. So now in this example, this is a 45-year-old chiropractor doctor. He has 9 third-party debts. That's about $478,000 in debt. And that's going to take him a long time to pay down. So he's paying about $5,777 a month, or almost 70 grand per year. And if he were to pay this back, it's going to be between 19 and actually 25 years. And he's going to pay around $319,000 in interest. That's a lot of money that's out of your life in that time frame. So pretty large numbers. Now, in this example, this doctor is going to deposit $25,000 into his policy. He's doing an annual deposit, by the way, annual premium deposit. I'm going to pause here for a second because a lot of people say, oh, $25,000, that's a lot of money. That's too much. Keep in mind, this is a doctor. These are his numbers, not your numbers, by the way. The other thing I'll mention too is people say, well, I don't have any. Where did he get the cash flow? Did he just have that lying around? No, he didn't actually. So this doctor, what he was doing was he was putting money into a 401k, IRA, and like something else, an SD IRA, I think, something like that. So he had a lot of money going into these retirement buckets, but he didn't like those buckets because they weren't performing very well. He had no control of them. The IRS obviously controls a lot of it. He didn't like that. So what he did was he redirected funds that were going to some of those buckets. So some of the funds and put those into infinite banking. So he just redirected his cash flow. His cash flow did not change. It just changed where it was going. Next thing I'll mention here is that when he deposited that $25,000, within 30 days, he was able to borrow out around $14,863. Now, the example that I'm redoing, I'm using a current policy where the cash value is more like 20-some thousand dollars. So it's a lot higher cash value. So it accelerates the whole thing. But I'm going to be very conservative with this example. So $14,000. So what's he do? Well, he goes to his bank. It's a guaranteed loan. He takes it out and he pays off the Discover card, the Lowe's card, and part of the Nordstrom's card. Now, what he took out was a policy loan. So keep that in mind. He took out a policy loan. So he's got a loan there, but he paid off those ones. So his monthly payments that were going to the debts went down by $448. Now, we don't want to lose that $448. We don't want that going back out the door and just going to somebody else. We want to recapture. Rule number 3, recycle and recapture. So rule number 1, he's paying himself first now, deposit. And then another rule, recapture that money. So he's going to take that 448 and put it back into his policy loan, repayment back, right? So it's going to knock that loan down a little bit. So what happens in year 2 now? Year 2, he puts in $25,000 into his policy as a premium deposit. The cash value from that jumps up by $16,000 and change, and the payments back to himself equals $5,374. So he has right around $21,945 of cash value available to borrow out because it's growing by dividends as well. So he borrows that back out, pays off Nordstrom's, Wells Fargo, private loan, and part of the BMW loan. Debts drop, monthly payment drops by $1,917. Repeat the cycle. Year 3, same thing. 25 goes in as a premium deposit. Cash value jumps up by almost $25,541. Payments back to himself equals $23,000 and change. Total cash he has now is $48,545. Same thing. Borrows it back out, knocks out the BMW, West Marine, and a big chunk of the condo. Now, I'm going to pause here for a second because, well, actually, you know what? His payments now have dropped by $3,677. So you can see how he's recapturing his cash flow. Here's what I want to make sure we understand. In the first 3 years, we put in $75,000 in the premiums, but we also took out $55,000 and change during those first 3 years. So the question is this: how much is in your policy earning you dividends? Is it $20,000? The difference between that? No, it's not. It's still the same amount. Roughly $75,000, give or take, is still earning you dividends, even though you've borrowed out $55,000 and have a loan of right around $55,000. You're still earning the same dividends. Uninterrupted compounding. It's pretty amazing. It's pretty powerful. All right, let's go to year 4. Year 4, same thing happens. 25 goes in, cash value goes up by 26,000. The payments of 3,677 back to himself equals 70,439. Total cash is 70 grand. So he borrows out 70 grand, pays off a huge amount of the condo. Now, the monthly payments do not change. Now, why do they not change? Well, the condo and the house are amortized mortgages. When you pay the principal down on those things, the payments do not change. So monthly payments in year 4 don't change. Now, in year 5, 25 goes in, cash value goes up by 27,000. Payments back to himself are 44,000, so total cash is now 71,000. Now he pays off the condo and a big chunk of the house. Payments or debt has dropped to just the house now, and monthly payments have dropped by 4,556. In year 6, this is what happened. So this doctor said, "Hey guys, I'm loving this concept. My cash flow hasn't changed or where it's going. I've only changed where it's going, but he says, hey." It's been, almost 6 years now, and I want to put more through a policy because I have more cash flow or something like that. Or maybe I can't remember if he's taking more from a 401k, putting into here, but he goes, hey, I want to do a second policy, but can I drop the premiums down on the first one? So Amy, this is your question. So yes, he dropped the premiums from $25,000 down to $10,000 on that first policy because he can do that. But get this, the cash value still went up on that first policy by $13,092. The second policy, he's going to do $25,000 on that one. And the cash value within that first 30 days is $14,000 and change. The payments back to himself of $4,556 every month, right, equals $54,000. Total cash he now has available is $82,000. House is only $76,000. So now he wipes out the house. His debts are gone. Now what happens? He's got a policy loan. There's a balance on that policy loan. Throughout year 6 and part of year 7, he pays back the policy loan. At the mid to end of year 7, he is now no debt, no bad debt. He's got 6 figures inside of his policy that is available for him to loan out to himself to go do investing, buy real estate, pay for his kids' college, whatever he wants, and no bad debt. So that's how it can work with debt. But he did that in 7 years instead of 19 years. And he saved himself, I did the math on this, he saved over $250,000 of interest. A crazy number he saved in interest by doing infinite banking. But once again, his cash flow didn't change. He just changed where it was going. He paid himself first. Now, if you're saying, well, Brian, that sounds really cool, but that's a lot of math because it is math. How do you do that? Well, we have a software, a platform called the Vault, and it's BYOBvault.com, and it maps out all this kind of stuff that I just showed you. It can map out velocity banking, infinite banking. It can show you how to pay down debts. It can show you how to invest in real estate deals with infinite banking, all that kind of stuff. So we have a software that maps this out for you. We also have what's called an implementation team that will actually map out, your strategy for you or work with you to make sure that you use the policy correctly. One of the biggest things that I see when it comes to infinite banking that people, I don't want to say make a mistake on, is they don't have someone to help them use it. So maybe they have somebody that sets it up for them, but they don't show them how to drive the car. They just sell them the car, but they don't let you drive it. So we have a full team that's all we do is help you use the policy correctly and for whatever you're trying to accomplish and whatever your goals are. So the last thing I want to mention is, kind of the millionaire method. How do you build that legacy? How do you really use this if you have no bad debt? What if I don't need that new car? Can I still benefit from, being my own banker, from doing privatized banking? Absolutely, yes, because that's where the fun begins. Because when it comes to like building wealth and stuff like that, there's kind of 2 steps I look at. The first step is get rid of bad debt. Bad debt steals wealth. That's money coming out of your pocket. The second step is you put your money to work or use good debt. Good debt just puts money in your pocket. So get rid of bad debt, create good debt, or put your money to work. That's really it right there. So this is that stage. So what are some ways that a lot of our clients or us and my colleagues, how do we use infinite banking? So active real estate investors, so think of like wholesalers, flippers, buy and hold, that kind of stuff. I actually have clients that are doing commercial properties. So think like apartment buildings, like, fourplexes, duplexes, things like that. Mobile homes, man, I want to get it back into that so bad. I love mobile homes as an investment strategy. Private funds or private lending private funds. So we have a whole platform called the Private Money Club that people lend money to other people. So it's being the bank and be in the bank again. It's kind of cool. Business owners. So a lot of business owners I work with, they're working very hard in their business, but maybe they're not taking any money off the table for the future. So infinite banking is a great way that you can take some of your revenue from your business, put it aside for, obviously down the road, but also still use that money to maybe grow your business or whatever you need it for while still having that growth for down the road. I do have some stocks and options traders that do infinite banking, maybe mainly options. A lot of guys are doing that. And then startups. So I have some clients that are starting up businesses, doing that kind of stuff, and even flipping equipment. So when you think of flipping, you think of like flipping real estate, but you can flip cars, forklifts, farm equipment. You can flip anything that has value if you can fix it up. So we have a lot of clients that do that kind of stuff. And I'm not sure if we have anybody on here that's doing that. I know, I'm trying to think if he's on here. No, I don't think he is. We have someone that's doing Turo, where you rent out cars, things like that. What I want to do now is I want to give you an example of a policy. This is a real policy, and how this person is using this. So this individual, by the way, private lender, okay? They're private lending their funds out, and they said, hey, I want to do infinite banking. And so this is what we did for them. So this is what we call a tabular detail. I'm going to break out some things here for you real quick. You're going to see the contract premium. You're going to see $150,000 there. So what does that number mean? So this person is doing a $50,000 deposit. So you can see that right there, 50,000 year over year over year. Now, what you'll see though, is the premiums drop over time. So you'll see it drops at year 8, then it drops at year 11. You can do that. So Amy, another follow-up to your question right there. So you can drop the premiums down over time. So this person did that. Why is it $100,000 higher in the first year? That is called a dump in. So this person put $100,000 in addition to the premium in year 1. It's an optional thing to do. We call that a dump in. Why that is attractive to a lot of people is that 90% of that dump in goes to the cash value within the first 30 days. And then you'll see over here is the cash value. So what I want to look at is how this thing performs as time goes on. Now, keep in mind, this person is private lending. So they're still lending this money. See that all this cash value over here is growing every year. They're lending that money out of the policy every single year, every single month they're lending out. But let's look at what this thing does at year 8. So at year 8, you can see the cash value went up by $66,000. But how much did they put into the policy? So it grew by that amount, but they only put in $48,593, but it grew by $66,000. That's the dividends, by the way, compounding. What's that mean? It means they had a 37% cash on cash return. That's a pretty good return on your money right there. I love that. But guess what? It gets even better because they're lending that money out. So let's do the math on this. So let's say they're lending at 12%. That's kind of hard money rates, they call that. They lend it out at 12%. They're already getting a 37% cash on cash return. And let's say their life insurance policy is going to be 5% for that loan. That's a 44% cash on cash return. Pretty darn good. Now, keep in mind, this person was already private lending at 12%. They're making 12%. Now they're making 44%, but they did nothing different because they already had the capital available. They did nothing different other than where the money went first, into the policy first, then back out into the investments. So the question is this: would you rather have a 12% or a 44% cash on cash return? Give me a 1 or a yes or a Y in the chat box if you'd rather have a 44% cash on cash return than 12%. Because I private lent before and I was making 12% and I never thought about making a 44% cash on cash return. Pretty big number. It's pretty awesome. Right? And that just snowballs, by the way, and it gets better and better every single year. That's the cool thing. Like the next year, it's not going to be 44%. It might be like 48%. So it just gets better and better because of the compounding. But how do you do that? Well, it's the same way that you eat an elephant, right? One bite at a time. Now, what do I mean by that? So if you look at someone who maybe they're doing infinite banking at a very high level, or maybe they're the person that, has a lot of money. How did they get there? Well, it just didn't happen automatically. They took that first step. And so my analogy is this one. A lot of times you see people pointing at the person at the top of the mountain saying, I want to be that guy. I want to be up there, but I can't get there. Well, it's because you're walking around the mountain instead of climbing the mountain. So the Millionaire method or building a legacy, you got to start climbing the mountain. That means taking that first step and doing something different. So this works for debt, it works for expenses, vacations, homes, and taxes. By the way, so taxes is a great one. So I have a policy, I borrow out of it to pay taxes, and then I pay the policy back during the year. And then at the end of the year, taxes again, pay taxes, pay myself back. That's how I do it. So I built that value up in my policy. I use it to pay my taxes because I'm an entrepreneur, so I only pay them once a year. And then I just use the policy to pay for that, but I'm growing my wealth at the exact same time. And I want that money working for me, not the IRS, by the way. So if you're asking yourself, well, Brian, how do you invest this? How do you know what to invest in? That's a personal choice, but we have software that maps it out for you called the Gains Projector. That's going to be in the vault, I think, here next month, by the way. But that software will say, hey, I want to do a real estate deal. I want to do something over here. You can plug it in and it'll tell you the most efficient way to run it through the policy to capitalize on that opportunity. So lots of cool things you can do there. Okay. But yeah, so we help you along the way, and we have all the tools and resources to do all that kind of stuff. Now that you know how this works, I mean, I believe that everybody, if possible, should do this because it creates generational wealth. It also protects your money. But very important, what it does, in my opinion, is it puts that control into your hands. Too much or too often, Wall Street, big banks, corporate America, IRS, government is controlling money, and that gives them the power. And I believe that we, the people, should have the power, not the banks. So that's one of my big reasons why I like infinite banking, because it puts that power into your hands and takes it away from, to be honest, those that want to steal it. Now, I got some more slides. We're not done yet. I got some other ones that I want to go through that point out some really important aspects of infinite banking. But I know we're getting close to the top of the hour. So if anybody has to go, I want to make sure we put in my call link. It's right there. So it's brian.beyourownbanker.com. So there's my personal chat or schedule link. So go ahead and grab that. You can schedule a call directly with me. And I love this picture right here, by the way. It's kind of goofy, but I've had this one for probably 10 years, this picture. But it's like, I always feel like too many people are the guy at the very bottom. You're working for your money, trading time for money, all that kind of stuff, versus we all want to be the guy at the top. Our money is working for us, right? And so that's a big transition that happens with infinite banking, is getting your money working for you. First step, as I always said, get out of bad debt, because that's you working for your money, and then create good debt or put your money to work. That's your money working for you. Okay, so by the way, so death benefit, okay, we're going to talk about that really quickly because that is a guaranteed legacy. Guaranteed legacy. We're going to talk about the loans that you control, by the way, which is awesome. When you understand how that works, it's mind-blowing. We're going to talk about the internal value. So by the way, when the policy is growing, dividends, by the way, they're not taxed at all because you're not taking the funds out. It's actually not taxed, so they grow tax-free. The policies, as I mentioned before, they are exempt from judgments and liens in most states. So it is a protected asset in most states. And then, of course, you can create tax-free income in retirement by doing this concept. So if that's one of your goals, you can always use this for income in retirement as well. Let's kind of talk through the death benefit really quick and why this is a kind of one of the unique things about this. So if you look at this example here on screen, this is a female, age 42. This is a real client, by the way. She wanted to put in $20,000 for the first 5 years, and then she wanted to drop it down after that. So you can see it right here. 20,000 goes in year 1, all the way through year 5. And I can't remember if she was doing, I think she was doing an annual premium or a monthly premium. I can't remember what she was doing. And then at year 3, she drops it down to 3,000 and change. She can do that. But look at this. $20,000 goes in year 1, but look at the death benefit over here. It's $325,000. Do the math on that. That is multiple times greater than $20,000. But look at what happens year over year. You'll see it right here. The death benefit goes up. Even when this client drops it down to $3,000 right here, the death benefit still goes up. For the rest of her life, her death benefit will continue to go up. Pretty powerful. At the end of year 5, she's put $100,000 into this policy. Now, God forbid something happens, get hit by a bus or, God forbid, but look at how much is there. Almost 5 times what she has put in is available for her beneficiary. That is also tax-free and it's guaranteed. So if you understand what I just said, over time, by the way, she's going to put in a certain amount and it's going to 10x for her down the road, for her family or whomever. You'll understand why wealthy families do this on every single family member, because they know that they can create 10 times the money tax-free guaranteed every single generation. And some families have been doing this for over 100 years. The Rockefellers, by the way, they're 10xing their wealth every generation. Very powerful. All right. Policy loans. They are guaranteed, by the way. So you ask and you shall receive. There is no credit check. There's no approval. Basically, you log in, you hit request loan, the amount you want, and it shows up in your account 1, 2, 3 days later. Pretty simple. The loans are also private. They're private. They do not show up on your credit report. So you borrow money to go buy a car. There is no loan on your credit report. So these are private and you are the one in control. There are no minimum or maximum payments on the loans. there is no required payment. So once again, no required payment. Now you should pay them back, of course, but you miss a payment, nothing happens. If you have a car loan with a car company and you miss a payment, what do? They take your car because they have the title. With this, if you bought a car, you have the title, you paid cash, it's your loan. Miss a payment, nothing happens. So the next question we get quite a bit is, how can I fund my bank? How can I fund my policy? So you can, there's the premium deposit like we talked about. That can be monthly, quarterly, or annually, and you can change that during the life of the policy. The next question we get is, what's the range of premiums I can put in? What's the minimum? What's the maximum premium that I can get approved on? Okay, on that deposit. So the minimum, the low end is 10 times your age per month, and the high end is going to be dependent on the individual. So it's going to be right around 20 to 25% in most cases of your gross income. So if your gross income is, or revenue is $100,000, 20 to 25,000 per year is the maximum premium. Okay, so that's the ratio right there. Now, generally speaking, what I look at is how much are you taking from your gross revenue and putting that aside or saving that, right? Because I believe we all have a saving problem. And so 10 to 15% is, what a lot of people recommend, but that can also be a number you can look at is, hey, am I putting 10 to 15% of my income aside, right? On top of the premium, there is what is called the dump-in. And I have some other illustrations I'll show you in a moment that illustrate these, but you can put in what's called a dump-in. And that can be savings. It can be from a 401k. It can be from a HELOC, by the way. But that's called a dump-in. And of the dump-in, 90% of it goes to the cash value immediately, well, within 30 days, and you can borrow it right back out. So a lot of people that want to pay off debts, as an example, and have some savings, they don't want to lose the savings. So they run it through the policy as a dump-in, capture that. Remember, recycle and recapture. That's rule number 3. They capture that money first in the policy, then they go pay the debts off, but they don't lose the future value of that money. So that's how that works. And then, 70 to 90% goes to the cash value within the first 30 days. All right. In this example, it's a female, age 32. She's going to do an annual premium of $10,000 per year. And you can see right here, premium drops down over time. So it doesn't go up, it goes down. And then she's going to do a dump-in of $50,000. Now, down here, you'll see in the first year, that means she put in $60,000. The cash value at the end of the first year, including dividends, is $55,000 and change. A lot of cash value inside there. But look at what happens in year 2. She puts in another $10,000. The dividends, because of the large dump-in up front, the dividends are higher because now they're being calculated on a larger balance. Her cash value went up by $10,607, more than she put into the policy in that given year. But let's fast forward down the road. In year 11, she decides, hey, I want to drop my premiums down. That's an optional thing to do. You can go to 0 if you want, by the way. She puts in still $3,120, but the cash value went up by $10,590, more than 3 times what she put into the policy because of the compounding. There you go. So you can see how that compounding over time gets bigger and bigger and bigger. Now, this is a quote. I'm not sure if Warren Buffett really said this one. I'm going to take this one out because some of my guys here have said, hey, change the quote to your quote. Because his quote says, if the poor people would just do what rich people do, they wouldn't be poor anymore. I do not like that quote. My quote is this one. If we have the knowledge of the wealthy and take action on that knowledge, we wouldn't be poor anymore, or we build wealth like the wealthy. So I like that one because if you have the knowledge of the wealthy, it doesn't mean anything. You have to put knowledge into action. That's what changes your life. You got to do something different. You got to put it into action. So that's an interesting quote there, but yeah. So one other thing I always get quite a bit is, hey, Brian, why should I work with you? That kind of stuff. So I've been teaching infinite banking for over 9 years. I don't know how many webinars and stage presentations I've done on infinite banking, quite a few. I love doing them, by the way. We have an entire team, though, also that sets up infinite banking for you. We're over 30 plus people on our team. Then we work with you today, tomorrow, and an ongoing basis. Our team, we are one of, if not the largest producer of infinite banking here in the US. So we have a lot of clients. I currently have over 100 clients in underwriting, and we have ongoing support and services. So we're going to work with you after the fact as well to keep you up to speed on using the policy correctly. You can call my cell phone anytime, that kind of stuff. And there's no cost to you. Like, we don't charge you anything to call us up or have us work with you. Now, we have the Vault software. There is a subscription to that one because it is a private software. It is proprietary for us. We had it custom built over 2 years. But other than that, there's no cost to us. You don't ever pay us a fee to go through the underwriting, all that kind of stuff. So another question we get quite a bit is an IUL or a VUL infinite banking? No, it is not. It is definitely not because as I mentioned at the very beginning of this presentation, if you look in the history of infinite banking, big banks, wealthy families have been doing this for a long time. They know what the best vehicle is for infinite banking. It is not an IUL. It is not a VUL. It is whole life insurance. There are some other things around these kind of things. So one, IULs and term insurance pay some of the highest commission. We take a pretty big cut in commission to do infinite banking with whole life, about 70%. And we only do infinite banking, by the way. But there's a lot of stuff out there on IULs and infinite banking. You can go do your own research, but we're just pretty adamant that, and by the way, we have personal experience using those kinds of products. They do not work. In fact, I had a client today has IULs and he is so upset with them because they're not doing what he thought they would. And then if you ever want to have a little fun, little quick read, go into Google or whatever and type in Kyle Busch IUL. Kyle Busch is the NASCAR driver. He just lost $8 million of 11 million in an IUL. And so there are definitely some lawsuits happening right now around that. So just be very, very careful with those kind of things. A couple things to keep in mind. So one of two things will happen to us in life, right? Well, one, we are going to live. We're living right now. That's why we're talking. So are we better off with or without infinite banking in our lives? Okay. And then, of course, we are going to die. Are we better off with or without this in our lives when that happens? In my opinion, a lot better off with this in our lives. So what is the next steps? Next step is pretty simple. Let's just hop on a call. Let's solve your problems. Let's talk about your goals. Let's talk about what you want to accomplish. And let's just see if infinite banking is a fit for you. Because here's the thing. If infinite banking is not a fit for you, I am going to tell you that straight up because it is not a fit for everybody. I'm very clear on that fact. If you can do infinite banking, in my opinion, it is an absolute privilege. It is not a right, by the way. It's an absolute privilege to be able to do this and have this in your life. And so let's definitely hop on a call. Let's see what you're trying to do. Let's see what this can help you accomplish. And let's see if it's a fit. That's pretty much it. But I like to end the presentation on this quote that we did at the beginning. And it's the one by Will Rogers that says, the problem in America isn't so much what people don't know, it's what they think they know that just isn't so. And a large part of what we're talking about, by the way, is money. How we think money should function, how money really works is not what we think it is. Because this is my opinion. As we go through life, we are programmed or we learn things from the outside, right? And we learn things around money. But in reality, what we learn is how to give control of our money away to somebody else because that gives them the power. And so a big part of, for me, infinite banking is gaining back that control of our money and eventually of our time. I love controlling time, by the way. It's my favorite thing. By the way, I've got 2 kids homesick and I'm doing this presentation with you because I control my time. So yeah, and it's been a life changer for me. So with that, though, everybody, have a great rest of your week. And I look forward to talking to some of you on a call here one-on-one very soon. All right, take care.